This is Kevin Gormley, a CPA that does financial planning with Leading Edge Financial Planning. And today I'm going to talk about why markets crash, okay? So I saw a program on the internet. It's fantastic that you can learn so many different ways, and teaching a course next year at Maryville College. So I saw a course from MIT with Andrew Lowe, and he gave this analogy about why markets crash. And I think it's a fantastic analogy, especially since we work with so many pilots and other people that have money and travel a lot. And so first of all, I don't know what's going to cause the next market crash. I don't believe anyone does know. If you look back on history, it's always obvious what caused the last crash. And sometimes we think that's what will cause the next crash, but we don't know. So what did Andrew Lowe say? Well, he told his students that when you think about traveling, okay, and I just traveled last week to Denver, Colorado. I went to the airport. I didn't expect there to be crazy traffic. There wasn't. I didn't expect there to be crazy traffic in the airport. There wasn't. I mean, it was just the usual mayhem, if you will. But when it comes to Thanksgiving, which is upcoming, during Thanksgiving, we know if we go to the airport at Thanksgiving, we know there's going to be traffic going to the airport. We know there's going to be a massive amount of people trying to get on a plane and flee to somewhere else, right? To go somewhere else. And the motivation to do this is very good motivation, to be with our family, spend time with our family or friends, whoever. But everybody is trying to get out of town at the same time. And so what Andrew said was that it's not so much about what will cause everybody to want to flee the stock market, because as human beings, we all have that fight or flight that goes into our brain when we see something that's very disturbing. But we don't know what that disturbing thing is going to be. But what we do know is that when everybody in markets get disturbed at the same time, it's sort of like going to the airport on a calm day versus going to the airport on Thanksgiving Day. Everybody is trying to flee markets at the same time. And you may say, well, that's not me. But again, our brains will tell us if the stock market goes down 20%, 30%, 40%, or even over 50% as it did in 2008, 2009, we are going to want to get out of town, out of the market town. We are going to want to get out of town. And so Charlie and I really believe it's extremely important to decide what you're going to do before that very non-Thanksgiving event happens where everybody wants to flee markets. And so we believe that we need to make a decision that we're going to invest through the markets. And what I mean by invest through, I mean literally that we're not going to do anything if markets go down. If you're dollar cost averaging, it's really easy to do that. If you're not dollar cost averaging, it may be more difficult. But that's really where bonds can help all of us stick with it. And what I mean by that is that if you have 100% of your money in equities and the market goes down 50%, if you have $1 million, you now have 500,000. If part of that is in high quality treasury bonds, most likely you are not going to be down 50%. So it's really the mix of stocks, bonds, REITs, real estate investment trusts, and other assets that will maybe make it less likely that you are going to want to go to the metaphoric airport and flee when markets crash. But this is really the reason why it's so simple, I know, but it's really the reason why every time that markets crash, it's because everybody is trying to get out of Dodge. And now, do we know when a market crashes? We don't know until after it's crashed. And by that time, it's probably near the pain point. So we don't want to do anything at that point. So how come all these people trying to flee causes a market crash? Well, they're sellers, right? They're trying to sell, and they're saying, I want to sell. And think about the airport and all the people that when you go to an airport, you see a lot of tight spaces. There's only so many chairs. There's only so many places to go in the plane. And all of these people are flooding and saying, I want to sell. So are there more sellers than buyers? No. Every stock share, every ETF share, when someone sells, you have to have someone else to buy. That's how markets work. There's always a seller and a buyer. You hear sometimes, well, there's a lack of buyers. No, there's always buyers. It's just that when everybody is flooding into the metaphoric airport and trying to flee, there's so many people that are doing that the buyers just kind of sit back. And, this is the Warren Buffett ideal of just kind of like sit back and ponder as opposed to allowing the emotional part of the brain to take over and say, look, all these people want to sell desperately. I'll buy, but I'm going to buy at much lower prices. So that's really what ends up happening in market crashes. And again, we don't know that there's a crash. The first couple percent down, I just warned you about this. We think, well, there might be a crash, and then it comes back again as it's done the last 8 years, 9 years, and then goes down a little further, and then we say, what is this? But we don't know what will cause the mass panic where all of a sudden investors all just say, I'm going to the airport, I'm getting out of town. We don't know what's going to cause that. But when that does happen, the best thing to do is just to be very, very slow in your thinking and ponder if it's a good time to buy. So thanks so much for watching.